Cool. And that's all it takes. And we're live with Now Next Later on Monday, June 2nd. Sasha, how are you doing today?
I'm doing great. How are you, Jer?
Excellent, thanks. I'm really excited to have Mike Yu on Now Next Later today. Mike, you and I have known each other quite a while. We go back and forth on topics all across housing and mortgage. And so it was hard to pick what today's topic would be. But Sasha and I have been talking a lot about cost and efficiency, particularly cost of originations to IMBs. Christy Succomet, who was on earlier a few weeks ago, was talking about her efforts to lower the cost of origination. And you have a lot of thoughts on this. So as everyone comes in from the waiting room, we're really excited to have Mike Yu, the CEO and co-founder of Vesta, on today's show. And we're going to talk cost and efficiency for mortgage lenders. How you doing, Mike?
Good, good. I am at Chairman's right now in Sea Island, which is a absurdly nice place, to be honest with you. It was very hard to get to, but it's very nice.
Yeah, I honestly don't even know how to get there from whether it's Charleston or Atlanta or wherever, Jacksonville maybe. How did you do it?
Yeah, so I had to fly Saturday into Houston, stay the night in Houston, and then take the morning flight from Houston to Jacksonville, and then sit in a car for 90 minutes. So could have been
KP,
easier.
KP was posting some videos on Instagram from the conference, so I thought Sea Island was a particularly good location to be talking about affordable housing and home affordability. So that's good. Good to hear.
Make sure
Good
make
to
sure you get
hear.
some flood insurance while you're there.
Oh gosh.
Well, good. Thank you for taking a step away from that event. I look forward to hearing about the highlights and the speakers and everything going on at MBA Chairman's. And in the meantime, one of the things I had sent you, and Sasha, I think you probably saw this too. I saw a post just last night from the CEO of Princeton Mortgage, Rich, talking about this exact topic. What does it mean to actually address cost? And so I'll just start kind of, since this is a now topic, as I laid out in the intro, Mike, we'll kind of toss the first question to you, and I'm going to make it a little open-ended. We'll try to get pretty specific here on the show, but there's a position I'll take, and it was similar to what Rich was posting on LinkedIn yesterday, which was we're not going to lower the cost of origination. Let's stop talking about it. It's a human cost. It is what it is. We may address it in the future. It may become something we lower fairly consistently or dramatically in the future. But today, for this year, we're not talking about lowering the cost, and it isn't going to be passed on to customers anyway. So let's just focus on what we need to do to modernize and stay relevant. So I'll lay that out as the thesis, and then I'll toss it to you. What is realistic about the expectations? What is realistic about the assumptions for lenders looking at both cost and technology?
Yeah, I mean, look, at the end of the day, at some point, everything's got to hit the bottom line, right? So I struggle with this, like, all right, we're going to modernize because you have to have a goal when you modernize. And, I love technology probably more than everybody else. But you still, I think that I've seen lenders, and one of the reasons we're having this conversation is you had some hot takes in the last couple of weeks on various podcasts where you more or less were saying, oh, we're not going to lower the cost. The cost doesn't matter, like all of these things. And I guess my claim would be that, in a mortgage lender, like everybody there are shareholders or owners and employees and all of these things. And for the business to run, you have to make money and you have to spend money. And you ideally have to make more than you spend, right? Like this is not some like novel new concept. This is just like how the world works. And so every time you implement technology, every time you spend your time on something as a leader of a mortgage lender, every time you do anything in your business, either it's got to help you make more money or it's got to help you spend less money, like to get the same results. Like that's really all it is at the end of the day. And the thing about mortgage is it's actually very hard to move your revenue line, right? Like you can improve your capital markets execution a little bit. You can go from best efforts to mint. There are things you can do, but for the most part, like everybody sells the same products. Everybody's money is green. You're either trying to get more loans. Your revenue per loan is roughly fixed within some, reasonable margin. Like I don't know of anyone working on a way to double your revenue per loan. Um, Nor do I think that that would necessarily make any sense. And so what you're left with is the cost side of the equation to improve your business. And so when people say like, all right, we're going to give up on improving cost, I think they're basically saying we are going to run our business as it is for the next, decade or 2 decades or whatever. And that's fine. Like some of these businesses now, they're reasonably profitable. People are happy. Like, there are lots of things to life that aren't work. But if you really want to improve your business as a mortgage lender, I don't know what you improve other than cost, to be honest with you.
Mm-hmm. So we have, I guess there would be, so everyone I'm posting, just put your questions in the chat and I'll keep an eye on it. So let's, Sasha, end on Mike or go to Mike's last question there. What is it that you should be focused on in the cost bucket? I really thought of two things, and that's why I'm tossing it to you. I'm thinking of marketing and I'm thinking of costs. Those are the only two levers. I say marketing, it's marketing sales, are the two levers that you've got. And so what you do with them matters. So what do you do?
That question for me?
Yeah.
No, sorry. I was like
No.
missed it there. Yeah, I don't know. I actually don't know that I fully agree with any of it. So I might just blow up the conversation altogether.
Go for it.
You know, I
That's what I was
think that
hoping.
there are opportunities to optimize across even all the areas where we do have humans today, processing, closing, underwriting, et cetera, where you could see an improvement in the cost to produce a loan. Or maybe instead of measuring the cost to produce a loan, we should be measuring something else. And that was kind of where I was going to go with my conversation. I still think there are some ways that we can pull out some costs for sure if we got more efficient, if we automated, particularly in a down cycle. We're not at the height of our personnel hiring level. And so, perhaps when we get back to an upcycle, you don't hire as quickly as you did before because you did the right things to automate certain aspects of the business when we were in the down cycle. So I think there's some room for ROI and some room for cost improvement there. But in the grander scheme, I start to wonder if maybe, and this has been a conversation that's come up a lot lately, ROI, because everyone's always like, oh, well, if I don't see the ROI, I'm not going to buy the technology. Is ROI the right thing to be calculating at this stage? Do we even know all the inputs, all the variables? Do we even have good baselines? Like, I'd ask lenders, like, do you guys measure much around ROI in your business today in general, with or without technology? Right? I don't know that we have great muscles or that we have the ability, like, it's like pinning a tail on a donkey, right? To really measure it in the most meaningful way that we end up seeing, like, hey, we did get our return on our investment. And so I almost wonder if we should be changing how we frame the question, right? Should we be looking for outcomes? Should we be looking for more value put into the system or more value extrapolated out of the system? And, keeping an eye on costs for sure. We don't want them to get any more outrageous than they are, but a lot of the costs that are outrageous right now are not within a lender's control. And so, if you can't control that, then you got to go find other things to control. And so I would be curious both of your thoughts on, like, should we maybe be measuring something else?
Yeah,
So
Mike, we're not talking about price. We're actually not talking about costs going up here. We're actually just talking about whether or not they go down. So I think that's a good point. So what is your response to outcomes versus
so
measuring?
I actually I agree completely with what you said, Sasha. But I think that there's like a should and then there's like a practical question, right? And my claim would be that like the correct thing to measure that we should always be that like as a business you should optimize is cost. And it's probably actually the other thing I will say is like we definitely measure cost wrong in this industry, which is like the MBA puts out a number every quarter or whatever it is, and you take the total number, like the total spend of the company, and you divide the number of loans they did, and they're like, all right, that's the cost per loan. And we all know that's like just a wildly like any economics like college undergrad will tell you that what you care about is the marginal costs, right? Like marginal cost is a very basic thing that everyone worries about. And I would say that probably most lenders do not have a way like the really firm line level accounting to understand if I did one more loan, what's it going to cost me? Because when someone does 70 loans in a month and then they do 71 loans in a month, they don't add the $13,000 or whatever it is to cost to do the 71st loan. Like that's not actually how it works. And so I certainly think that we are not necessarily measuring cost correctly. I think that is a different conversation from, hey, is cost the thing that lenders want to optimize? Is that the business thing people like? I would claim that it is very much a thing business people want to improve. I would claim it's like the right thing to measure. I would claim that getting your marginal costs down is probably like the right business case to make as a lender. And I will also acknowledge, Sasha, what you said and what I said just now, which is like most people are not measuring that. They don't know how to measure that. People always ask me like, hey, you implemented Vesta. Did people's costs go down? I'm like, well, the customers are happy, but like I couldn't tell you what their cost was before, and they can't tell you what their cost is after. So like, what are you going to do with that? But I think that's a different conversation. Like the how do you measure it? What are the proxies for it? But like anything else you'd be measuring as a proxy for cost, right? Like if you want to measure, like number of man hours spent on a loan, which some people have talked about doing. If you want to start counting like number of tasks, which some like these other things are kind of proxies for cost. And so to me, that is admitting like, hey, as an industry, we cannot do rigorous enough accounting to get to true cost, and therefore we are going to try these proxies. And that's fine if people want to do that. But again, you would only be optimizing those numbers in service of optimizing cost. Like if you actually reduced man hours, but it cost you the same, I don't think you would really care as a business, if that makes sense. And so, yeah, there certainly is a conversation to be had about like, are we measuring the right thing? What should we measure? I certainly think cost per loan as traditionally defined by the industry is actually like not a very good metric for anything. But I do think that marginal cost per loan is like the right thing to measure and move. And if we agree that we have to find some proxy to measure it, fine. But to me, it's also a little defeatist. Like I would say that, we for the most part as an industry haven't really tried to even measure marginal cost per loan.
So I want to pick up on this question of the defeatism, because I've definitely felt that in terms of the confusion around trying to help lenders either begin to measure it or begin to state what they're trying to do, if not focus on that. And so let's pick up there. What is the flip side of that coin then, Mike? What is to say the optimistic view of what is possible when you get into this question of, I know I have to make changes. I'm watching everybody adapt. I'm watching everybody modernize. I'm hearing what it's like to go through my process, and I'm seeing the data for my team members and my customers not change all that much over all this investment and focus. So then what's the flip side? What am I doing with my technology partners today in the now bucket?
So I think that when it comes to reducing cost, everyone's like, all right, we're going to add some technology to reduce cost.
Mm-hmm.
This is like what everyone has been trying. And you will notice I very specifically say add technology to reduce cost because it obviously makes no sense. Like that's just clearly, I promise you adding technology will add cost if that's all you do. And so you have to reduce something like you're reducing costs. So figure out like what are you subtracting from the process? What are you having people not do anymore? What, other things are you cutting? Whatever it may be. I think that there's this like we've done a lot of investment in adding and not a lot of investment in subtraction. And I do think that subtraction is just like a really hard phenomenon at companies in general, like at any organization of people. One thing that actually, like in Silicon Valley and startups, one thing that we often say is like the only person with the power to subtract is the founder. And so I
Mm.
don't know if that's like gonna always be true in like all of these other analogs, but it's a thing I think about a lot, which is, how hard is it? Like everyone, listening, both of you have worked at companies where you get a recurring meeting put on, and then how hard is it to get rid of the recurring meeting? Like you
Yes.
you go to this meeting for like months and nothing happens on it and it has long outlived its value and yet it keeps happening. And so like in Silicon Valley when we talk about only the founder can get rid of it, there are stories of how Toby at Shopify like every quarter will delete the whole calendar. Like everyone's calendar gets deleted and he's like, and you've just got to, because the organization is really good at adding stuff but really good at subtracting. And mortgage processes are very much the same. And so what I tell lenders is, especially as we look at doing new implementations of Vesta or whatever, people are like, hey, we really want this to save us money. What I tell them is we can add all the technology we want. If you, as the leader, do not go in and say, we don't need to do this anymore, we don't need to do this anymore, we don't need to do this anymore. And that has to be a leadership level decision because no one below you is frankly going to feel empowered to take that risk. Then you're going to end up with added cost because all you've done is add steps and add things to do and add people you pay and add mouths to feed and all of those things. And so I think it's just like subtraction is really hard. Subtraction has to come from the top. And in some ways it almost can't be delegated. And if you don't subtract something from your shop, I don't know how you expect to subtract cost.
It's a great call out, Mike. And I think you're hitting on what David's asking in the chat, which is, okay, if we know 50% or more of the cost to produce is sales staff and we're not going to, change that, then let's focus on the other part. What can we change? And I think what you're talking about is twofold. One, there are places to optimize with tech, but you can't have tech on a shelf, right? You can't buy the technology and then expect that it's going to reduce cost. It is going to just add cost. Now, if you optimize it and use it the right way, and work with your partners to figure out, let's say, from a how do we reduce cycle time? How do we decrease fallout? How do we look at, less touches per loan, right? Then yes, I think that's where you can start to see the cost come down because you're reducing what you're referring to, Mike, which is waste. And it has to start at the top. Like the top leadership has to say, I'm committed to figuring out where we've got waste in the process and how we can look at either through process efficiency and or technology efficiency plays to bring those numbers down so that we can at least manage the costs that we can control.
So
Yeah.
here's how I'm thinking about this, because I'm trying to frame it up in a very practical sense for especially lenders and those in operations who are picking the technology partners who watch this show and who we work with. And so what I'm hearing is if we control for costs, if we say, okay, it is where it is right now, and the best we can do is plateau because of the commodities and because the revenue is locked in by the investor, we have a couple of options. One, I think Sasha made a great point that one of the great options is if you reduce friction, touch points, and tasks, presumably both your team members and customers have a better experience. I have not seen a ton of data to say that consumers are having a better experience. I could be wrong. I think the refi experience at Rocket, the refi experience with some large digitally enabled technology companies, pretty solid. I think refi overall, maybe I would even say, is okay, good enough. But I don't see a bunch of people saying, wow, the mortgage industry is different than it used to be. It's better in this way or this way in any kind of like real way. And so then it becomes team members. I do think our team members are having a better experience, but I don't think anybody's measuring that externally, at least. And so where does that leave us? How do you take that benefit that we think might be there and turn it into a sales or marketing benefit, which gets you more of those marginal loans? Because as you said, each loan you do after a certain number is more valuable to you because it doesn't cost $13,000. And we don't know what that breaking point is, but how do you do that is my question, Mike.
Well, I will say when we say things like, "Oh, the experience hasn't gotten better," I think that that is a like harder to measure than cost, and like to be a little bit defeatist here.
It
And
is.
like, I the other problem is like you're not being scored in a vacuum. Like I would say probably if I had to guess in the last 10 years, since I've been in the industry, the consumer experience has improved. I would also say that like the world has improved for consumers. Like I 10 years ago, it was hard. You had like hail a taxi in most places. Now I get in a car that drives itself. It's like the world has moved a lot in 10 years and mortgage has moved, but not as much as everything else. And so you have to remember like all these consumer surveys when people are like, what's the most stressful thing? Like, what's the NPS of mortgage? All this stuff. You're always implicitly graded on a curve, which is you're graded on the curve of like everyone else's day to day. And so I think it's kind of like, it's too depressing of a worldview to say like, oh, we haven't made any progress. It's just like the world makes a lot of progress and you get graded on that curve. And on that curve, the consumer hasn't seen relative progress. That's thing one. Thing two is that, the consumer also only comes back every 7 years. And so it's really hard to say, you know, oh, no one is saying the mortgage industry is so much better. Do people remember, like, no one thinks about it as much as we do. Like, do people remember how bad it was 7 years ago relative to now? Like, the one that's now always feels bad. And so I don't know if I would say that, like, it's probably much harder to measure whether the consumer experience is getting better, in my opinion, than to measure marginal cost. And, like, marginal cost is an accounting problem. Like, we could figure it out if every owner of every IMB and bank was like, we're going to figure out our marginal cost. Consumer experience, I think you've got a lot of other stuff.
I will say this. I am a little bit affected by people in my life who have done mortgages either previously or recently who say, what is it that you guys are doing? They literally say, because it's not great. Like they will say, like, aren't you supposed to be the innovation guy in mortgage? Like, what is going on over there? I had to do this. I had to do this. I had to do this. The title industry hates it when I bring it up. But I will tell you, more than half the people I talk to in my life who aren't in this industry think title insurance is a scam. They use that literal word. The professionals in our industry know it's not a scam, but the fact that consumers use that word, I mean, I get a lot of anecdotal feedback, which I know I can't make scientific
Yeah,
conclusions,
yeah.
but in my life, people are like, aren't you supposed to be fixing this? What have you been doing?
I mean,
Jerry, you and I both worked for closing companies. Okay. So, like, a good example of where and why we need crisis in order to implement technology, which is again, why we're like this call is now no longer is it now next later, it's just defeatism. But that being said, I mean, look, before COVID, we were at less than 10 states Ron approved, post COVID over 40, right? So when rubber meets the road and we have to have a solution to make it easier for people because there are obstacles in our way, we will do it. I mean, maybe we need to create some fake crises to like push our industry forward a little bit, because most of them, most lenders, you all probably know this, you're on a call, like you bought some type of an e-close solution. And then when COVID ended, you went back to the way it was.
Yeah.
But and look, e-close isn't a silver bullet. And there's a lot of value in it depending on the scenario. You got to meet your lenders where they're at, or sorry, your consumers where they're at. And there are more and more consumers coming into play that grew up with technology in their hands. They are going to want a digital experience. They're going to start demanding it more and more. And I think we will be pushed to have to do it, whether we want to do it or not. But we shouldn't need a crisis to push us, is my point. And I do think there are places where it has gotten better, and we at least have the optionality. So if you have somebody that lives in a rural area and they don't have a computer, or they don't like computers, and they're going to go sit at the title desk and sign all the papers, great, that works for them. And then if you have somebody who is an investor and can't be on site, or you have somebody in the military that can't be on site, and you have the ability to give them that option to close remotely, what a fabulous experience. So, putting in a one punch for the Stabbies and the Snapdocs of the world. Keep going.
That's right. So Mike, let's do that. Let's step forward into the future. You are very good at this, looking ahead and saying, here's where I think the practical steps are. Here's where technology is able to take us. So let's do it. Let's end here. We have 10 minutes left to end on a what's coming positive note. So if we are going to make incremental progress, and we're going to look backwards at 2025 and say, okay, we went from here to there, and it is going to be this very methodical, very incremental step forward, what is the next step for that lender expectation? What should lenders be expecting to work on? You are building that core piece in the middle. Sasha and I talk a lot about data verification, about the eligibility data coming from credit, coming from income, things that pump into the LOS. Obviously, we just mentioned e-closing, so it's a perfect segue there. Like, what is the reasonable, methodical, incremental innovation that lenders need to be focused on?
I think that it goes back to what I said about reducing cost, and it's just you've got to figure out what you're subtracting. And that starts with, like, I hate to say it, but it starts with an inventory of, like, what are you actually doing today? What does that cost you? What does your line level accounting look like? Like, make sure you're solving and measuring the right problem, which is what is your marginal cost per loan? Not like take the CEO's salary and divide it by the number of loans you did every month, which, by the way, is in that number. Like, whatever that 13,000 number is, it includes your CEO's salary divided by the number of loans you did, which is obviously like an irrelevant number. Your CEO doesn't make a higher salary when you do more loans, I think. Otherwise, I need to have some conversations with my board. But I think that it's about measuring the right thing, and then it's about inventorying your process, and it's about, hey, what is the tooling that is going to help me understand that and start subtracting stuff? And I think that if we really start to build that muscle, like if mortgage companies start getting good at subtracting steps from the process, and part of it's cutting waste, and part of it is then you can implement technology and you can actually subtract stuff, that muscle just doesn't exist today. And if that muscle exists, I think you'll actually start to see a lot of what the industry has been working on: verified data, day one certainty, like, certainty through the capital markets, e-closing, all of those things, all of that promised ROI has just been kind of like building up, and has, in my mind, has just been trapped behind this problem of now we're doing it 3 ways or 4 ways or 5 ways, and we haven't subtracted the old ways yet. And so I think that if lenders get really good at inventorying what they're doing, measuring the right thing, and actually doing the subtraction, which is by far the hardest part, I think you'll start to see almost like a significant release of ROI all at once. And if we're talking about the right kind of cost, that should come down. Will cost per loan come down? If volume contracts, cost per loan is going to go up because all those fixed costs, the numbers all get messed up. And so cost per loan is a very noisy metric. But if you figure out how to measure marginal cost per loan and you figure out how to subtract stuff in your process, I think the next is that will improve. And the later is like, you know, I think you can get operational costs probably in like the fullness of time, way down. Like human should be close to zero. And then, David asked about sales cost. That's a whole different conversation about, everyone sells the same mortgage products. It's kind of commodity. When you're in a competitive market, you're going to have, profit pressures. That's just basic economics. It is nice that there'll be no downward pressure on revenue probably, but you'll get this upward pressure on sales costs. And I think someday, like one of the nice things about the mortgage industry is because your revenue is kind of, fixed by such a big entity on the other side, and then your sales costs are kind of like capped by regulation. There is this nice like profit spread that can exist if you don't fill it with operational cost because all you do is add stuff to your process.
So the good news is profitability is there. You have to be able to work both sides of the balance, as Mike just said. But for lenders, it really is more about profitability. And actually, probably that tells the story of some of the top digital lenders over the last 10 years who just quietly did bank that profitability, honestly, made it, banked it, didn't measure it publicly, didn't release it publicly until such time as they went public. And now we're seeing more and more margin numbers, obviously. But I think that is the key here is what are your tasks and what can they, what can they address? I guess that leads me to the last question, which I have to ask, even though I know everyone on the call might roll their eyes, which is technology doing these tasks. And I want to be really specific because we've been at 50,000 feet, 30,000 feet for a lot of the conversation. How do I think about the process, the change management in particular, when I want to take a task and start delegating it to technology? I've identified it as friction. I've identified it as one of the things I've inventoried, to Sasha and your point a minute ago. I've inventoried my tasks. I found 3. I am now going to try to take those 3 and delegate them to technology, but I eventually have to subtract something. Can you walk through some steps that are like the way you would think about that problem?
So I will give people the traditional way and the Vesta way. And this is why we had to build a
Great.
wall.
Perfect. Yeah.
And the traditional way is like, let's just very concretely take clicking the order flood button, right? Which is like super simple to automate. You can automate that today in any system. Like if your system can't automate that, like they all can now. Like this is like the easiest thing to do. So today you have some processor that like some setup person, they open the loan when the LO submits it or whatever, and they click order flood. And that's like one of the 5 items on their checklist. The easy stuff is you write a rule to automate ordering flood, and then you send out a new checklist that now only has 4 items. You know, it used to say order flood at the top, and now it doesn't. The first checklist item is whatever else, whatever they do after. That's all great. In theory, you would hope that that would be it. The problem is actually no, you have to make sure that all the processors or the setup people actually open the new checklist. You have to make sure that's the one they print out and they put on their desk or whatever it is. You have to make sure that, they delete the old one, or when they do like a spotlight search to find their checklist to pull it up, they don't accidentally open the old one. And then you have to, really delete the old checklist and replace it with a new one, which is a hard and complicated process. And then you've got to like take out the mental wiring where a bunch of them have just memorized the checklist because it's only 5 things. The setup person gets the loan and the first thing they do is to go to the flood page and they order flood. Um, and so there is this like actual huge amount of work that goes into subtracting this one task, which is not as simple as sending out an email, right? It's like the people actually have to change their behavior, what they've learned, etc. And so a lot of, what we have tried to do at Vesta is to say, hey, instead of the checklist living in people's head or living inside of, a PDF or whatever, can you have the system deliver it to people, and then people get in the habit of only doing what the system tells them to do. And then it really should be as simple as removing, the configuration, which tells people to order flood. Now that's what I will tell you is like your people are not used to that. So you're kind of front loading all that change management up front when you implement the new LOS. And that's why it's like you have to implement the whole LOS, because you really have to like break the people's brains one time as opposed to like repeatedly breaking them every single time you want to subtract something. And maybe that's better, maybe that's not. Like the market will bear that out. But it is like an extremely tactical exercise, and you go bit by bit by bit, and that mandate has to come from the top, and it's very hard to delegate. And that combination of things just means that it like hasn't been getting done.
How and when I want to break my team's brain, I think is a great way to put it. I'm gonna capture that and definitely use it. What are your thoughts on once you've started the process? There's this question of like, how do I celebrate it? Because my person just found a new checklist, and maybe I even got them. I did the hard work and I got them doing it, and now they have 4 instead of 5 tasks, and I want to keep the momentum going. Have you had experience at Vesta, or what are you thinking is going to be the experience of lenders as they try to show like, no, this is actually what we meant. This is happening. How do you do that?
How do you go from 4 to 3 to 2 to 1?
And keep it
Everybody
going.
celebrate.
Yeah, how do you
Celebrate, use
keep
the
everybody
momentum
on
to keep
board?
going.
Yeah. These
Yeah.
are small wins. I'm trying to really think about being optimistic and positive here, but what we're talking about is so incremental in my mind that I get like, how in the world do I get excited about that? But I have to, because that's the business we're in. So
So
how
as like a technologist, I'm kind of bad in this way, which is like in technology, the canonical belief is you always do small incremental releases. And you release something small every night, and like we ship code every night, and that's like a big technology belief. What I actually tell lenders often is like people often say only switch your LOS, don't switch your doc gen provider, don't switch everything at once. What I actually tell lenders is like sometimes you should just bundle stuff because it turns out that while technology it makes sense to ship it iteratively, I think the world has really swung the pendulum in the direction of like you should do everything super iteratively. And sometimes you have to kind of like big bang it out. Like especially for something that's super change management heavy, for something where and so my answer would honestly like the order flood example I gave you is a stupid example because no lender is going to go through all of that trouble and all of that change management and all of that heartburn in order to
Just the flood.
subtract that one item. The reality is the ROI on that project is you're going to spend like $100,000 of like brain damage implementing that project, and you're going to realize the returns in like 2100. And so the actual answer is you have to do big enough chunks. Like you can't actually have tiny wins, is kind of my mental model for this. You have to go for big chunks. And it's because you're going to do all the change management anyways, do it fewer times. And so your question or that I asked about like how and when do you want to take the brain damage? My claim is the best way to do it all at once and just move them into a new system. But
Yep.
you could argue, hey, you should do it in 5 chunks. You want to do all of income and all of collateral. And like, I think there are arguments you can make. I think doing it in like 500 chunks is frankly like just highly inefficient and wrong. And I would love for somebody to tell me like, no, I have managed to do it in 500 chunks and this is the rhythm I've gotten down and I celebrate the small wins and we've got the momentum. I would love for someone to tell me that. I have not seen anyone do that. And so in many ways, Jeremy, my answer is like our example was a little bit contrived and you do big enough wins that the ROI of each individual big exercise basically is worth it.
I'll say this to add to what Mike said. I don't have enough data points to give it like, a Stratmore report, call it. But what I have seen in past lives is when you're in a distributed model, it is easier to do that. Like, even though it's painful, you have more success because it's just trying to get everyone to come along. So sorry, but IMBs, the big bang, it works. It's painful, and you just need to be aware of the pain that you're going to endure as you go through it, but it works. Credit unions, banks, it could go either way, but they have a higher success rate doing it incrementally because it's more centralized in how those decisions are being made sometimes and distributed out, at least based on handful of clients I worked with in closing products.
I think
Yeah.
that's exactly right. Because I think the way to think about it is how big is your human change management cost that's going to be there, whether you a big or small project. And the
Yeah,
bigger that human change management cost is, the bigger the project has to be to make it worth crossing that hurdle.
totally. And I remember working with an IMB that did change their LOS in 3 months. And I was like, are you insane? How did you do that? And they're like, it sucked. It was painful, but guess what? It's done. So
Here we go. Well,
awesome.
I really like this conversation. I want it to continue. I know it will as we get together at events, and obviously we'll have Mike back and keep talking about these challenging topics. So we have to wrap it up for today. The one thing you made me think of was as when I was at Rocket, as we went further and further into the wholesale channel, was in capital markets, and we kind of started to circulate this idea from one of the leaders about brand the bland. Like we are going to do bland things, but brand them in a way that explains why you're doing what you're doing. And so if you are caught in that problem, brand the bland might not be a bad internal or external strategy for sales and marketing. So with that, thank you, Mike, for being here. Sasha, great talking to you as always. And we'll post this on YouTube and we'll be back next week. Take
Cool.
care.
Good to see you guys.
Bye.
Good to see you, Mike.